It begins with a jolt to the financial system. The Federal Reserve announces a dramatic increase in interest rates, pushing the benchmark rate to 10%. This unprecedented move, far higher than typical historical levels, sends shockwaves through the U.S. economy, corporations, financial markets, and households alike. Investors, consumers, and policymakers scramble to understand the far-reaching consequences of borrowing costs rising to double digits. The immediate impact is on borrowing. For households, mortgages, car loans, and personal credit lines become exponentially more expensive. Monthly payments for new mortgages rise dramatically, discouraging home purchases and refinancing. The real estate market, which has long been fueled by cheap credit, experiences a sharp slowdown. Housing sales decline precipitously, construction projects are delayed or canceled, and property values adjust downward to reflect higher financing costs. Home builders, real estate agencies, and mortgage lenders face immediate revenue contraction. Stock valuations for companies in the housing sector plummet as analysts revise growth and profit expectations downward. Consumer spending contracts rapidly. Higher interest rates increase debt servicing costs for households, reducing disposable income. Credit card balances, personal loans, and auto financing become significantly more expensive, forcing consumers to cut back on discretionary spending. Retailers, restaurants, and service providers experience declining sales volumes. Stock market sectors tied to consumer behavior, including consumer discretionary and retail, experience immediate and sustained corrections. Corporate debt becomes increasingly burdensome. U.S. companies carrying significant leverage face sharply higher interest expenses. Highly leveraged firms in sectors such as technology, manufacturing, and utilities struggle to maintain profitability. Companies postpone capital investments, freeze hiring, or reduce dividend payouts. Stock valuations adjust downward as investors account for higher default risk, reduced earnings, and slower growth prospects. Credit ratings for some firms are downgraded, increasing borrowing costs further and creating a feedback loop of financial pressure. The banking sector faces dual pressures. On one hand, banks benefit from higher rates through increased lending margins. On the other hand, elevated default risk among households and corporations creates uncertainty. Non-performing loans rise as borrowers struggle with debt obligations, prompting banks to increase reserves. Lending slows as institutions tighten credit standards, reducing economic liquidity. Financial stocks fluctuate as investors weigh higher profit potential against systemic risk. The housing market enters a sharp downturn. Mortgage rates approaching double digits significantly reduce affordability. Potential buyers exit the market, leading to a decline in demand for new and existing homes. Construction companies, real estate brokers, and home improvement retailers face reduced sales. Housing stock values adjust downward in response to decreased buyer activity. Real estate investment trusts, REITs, experience immediate stock declines as rental income and property valuations are reassessed. Auto and consumer durables. Industries face contraction. Higher financing costs for car loans, furniture, and appliances reduce purchases. Manufacturers and dealerships experience declining revenue while inventories accumulate. Stock prices for automotive and consumer durable companies adjust downward as analysts factor in slower sales and potential margin compression. Investment markets experience extreme volatility. The sudden 10% interest rate shocks bond, equity, and commodity markets. Treasury yields rise sharply, causing bond prices to decline. Stock markets, sensitive to corporate borrowing costs and consumer behavior, experience steep corrections. Growth-oriented sectors, particularly technology and high-leverage industries, face the largest declines. Defensive sectors such as utilities and consumer staples experience relative stability but are not immune to macroeconomic pressures. Corporate investment behavior shifts dramatically. Companies delay expansion projects, R&D initiatives, and mergers or acquisitions. Capital-intensive industries, including energy, manufacturing, and infrastructure, experience reduced activity due to higher financing costs. Stock market valuations for capital-heavy firms reflect slower growth and increased operational risk. Inflationary pressures initially decline. Higher interest rates suppress borrowing and consumer spending, cooling demand-driven price increases. However, supply-side costs remain elevated, creating a complex dynamic between slower economic activity and persistent input costs. Investors closely monitor CPI, PPI, and other inflation indicators to gauge long-term economic trajectory. Stock market reactions vary based on sector exposure to consumer demand and input costs. Corporate defaults increase. Highly leveraged firms unable to absorb higher interest expenses face bankruptcy risk. Distressed debt markets expand, providing opportunities for some investors but increasing systemic risk for financial institutions. Stock prices for vulnerable sectors decline sharply while investors flock to safer assets such as treasury securities and gold. Small businesses face acute challenges. Companies relying on credit lines to manage cash flow experience higher financing costs and reduced access to capital. Many are forced to cut employees, reduce hours, or close operations. Local economies dependent on small business activity experience contraction, and regional stock markets, if exposed, reflect reduced economic vitality. The consumer credit market contracts. Higher interest rates discourage new borrowing, and existing borrowers struggle to service debt. Credit card delinquencies rise, auto loan defaults increase, and personal bankruptcy filings surge. Financial institutions tighten lending standards, reducing overall liquidity in the economy. Stock valuations for banks and credit card companies adjust to reflect heightened risk. Corporate dividends are cut. Firms prioritize debt repayment and liquidity preservation in the face of elevated borrowing costs. Income-focused investors reduce exposure to dividend-paying stocks, leading to adjustments in stock indices and sector performance. Defensive strategies become more prominent among portfolio managers. Housing construction experiences prolonged stagnation. Developers delay or cancel projects due to financing costs and lower buyer demand. Labor markets in construction and related industries experience layoffs or reduced hiring. Stock prices for construction firms, building materials suppliers, and home improvement retailers decline in response to slower activity. Government debt servicing costs rise. Higher interest rates increase the cost of issuing new treasury bonds and servicing existing debt. Fiscal deficits widen, creating pressure on public finances. Investors monitor U.S. Treasury yields, bond market performance, and government fiscal strategies closely, influencing overall market sentiment. Corporate mergers, acquisitions, and private equity activity slow dramatically. High financing costs make leveraged buyouts prohibitively expensive. Growth equity investments decline as borrowing becomes costly, reducing funding for expansion and innovation. Stock market indices for investment firms and financial services reflect reduced activity and profitability. Stock market volatility persists over the medium term. Investors adjust portfolios to account for higher borrowing costs, reduced consumer spending, and increased corporate default risk. Defensive sectors gain relative strength, while growth and consumer discretionary sectors face prolonged pressure. Hedge funds, mutual funds, and institutional investors recalibrate strategies in response to sustained interest rate shocks. Employment patterns shift. Layoffs in consumer-facing industries, real estate, and construction increase. Hiring slows in capital-intensive sectors while defense, healthcare, and essential services maintain relative stability. Workforce retraining programs are implemented in some regions to address sectoral shifts, but unemployment remains elevated, influencing consumer spending and corporate revenues. Global trade patterns are affected. U.S. exports may become relatively cheaper to foreign markets, while imports become more expensive due to stronger dollar impact and higher domestic borrowing costs. Multinational corporations adjust production, sourcing, and pricing strategies to maintain profitability. Stock valuations for export-heavy firms fluctuate in response to shifting competitive dynamics. Energy markets experience mixed effects. Reduced consumer and corporate activity lowers domestic energy demand, partially offsetting global energy price shocks, utility companies adjust to slower growth but benefit from higher interest rate margins on corporate financing. Energy sector stock prices fluctuate based on demand, supply, and financing conditions. Investment in infrastructure and innovation slows. Public and private projects requiring financing experience delays or scaling back. Long-term growth prospects for technology, transportation, and urban development are constrained, affecting stock valuations and economic projections. Consumer sentiment deteriorates. Rising borrowing costs, reduced disposable income, and slower economic activity create caution in spending, savings, and investment behavior. Retailers, hospitality, and service sectors experience revenue contraction, influencing stock performance in discretionary categories. Banking and financial services recalibrate risk. Lending standards tighten, default risk increases, and credit availability declines. Investment strategies shift towards safer assets, creating volatility in equities and bond markets. Stock prices for banks reflect both opportunity and higher interest margins and risk from potential defaults. Real estate investment trusts and property funds experience stress. Reduced transaction volume, lower occupancy rates, and higher financing costs decrease income. Stock valuations for REITs adjust downward in response to long-term interest rate pressure and slower housing market activity. Corporate strategy shifts toward debt reduction and operational efficiency. Companies prioritize liquidity, cost control, and selective investment, reducing growth initiatives. Stock market valuations adjust to reflect slower revenue growth and heightened uncertainty. Consumer electronics and durable goods markets contract. High financing costs reduce purchases of big-ticket items, delaying product adoption cycles. Retailers adjust inventory, marketing, and pricing strategies. Stock prices for electronics manufacturers and retailers fluctuate based on consumer demand sensitivity to interest rate changes. Corporate bonds and leveraged loans face increased default risk. Higher interest expenses and slower revenue growth create pressure on borrowers. Investors reassess risk, demand higher yields, and adjust portfolios, contributing to volatility in debt markets. Stock prices of financial institutions exposed to corporate lending reflect these dynamics. Small towns and regional economies feel prolonged economic strain. Communities dependent on housing, retail, and construction experience slower growth, reduced tax revenue, and job losses. Local banks, service providers, and small businesses adjust operations in response to lower consumer spending, influencing regional economic stability. Stock market indices reflect long-term adjustment. Growth sectors, particularly technology, consumer discretionary, and capital-intensive industries, face valuation corrections. Defensive sectors, utilities, healthcare, and essential services experience relative stability. Investors balance risk and opportunity in a high-interest rate environment. Corporate debt refinancing becomes more difficult. Companies face challenges rolling over existing obligations at elevated rates, increasing bankruptcy risk. Stock prices for highly leveraged firms adjust downward, while firms with strong balance sheets gain investor attention. Global investment flows shift. International investors adjust exposure to U.S. markets based on interest rate impact, growth prospects, and currency strength. Stock prices for multinational firms fluctuate with foreign exchange, trade patterns, and economic growth projections. Consumer savings patterns evolve. Higher interest rates incentivize saving, reducing consumption further. Retail, hospitality, and entertainment sectors experience revenue decline, influencing stock performance. Portfolio allocation strategies shift toward low-risk, high-yield assets. Corporate and personal bankruptcy filings increase. Higher debt service costs combined with reduced revenue and slower economic activity lead to business closures and financial distress among households. Stock markets react to increased uncertainty and potential systemic risk. Financial markets gradually adjust to a new normal. While volatility remains elevated, investors begin to price in sustained high interest rate conditions. Defensive strategies dominate, and growth-oriented sectors experience slower but steady recovery based on balance sheet strength and operational adaptation. The scenario illustrates how a sudden rise in interest rates to 10% cascades through all sectors of the U.S. economy: housing, consumer spending, corporate investment, banking, financial markets, and employment all face immediate and long-term consequences. Stock valuations reflect both heightened risk and sectoral opportunity as investors navigate an environment of sustained high borrowing costs. Ultimately, the U.S. economy must adapt to a prolonged high-interest rate regime through debt reduction, operational efficiency, strategic investment, and consumer behavior adjustment. Recovery depends on corporate resilience, financial market adaptation, and careful fiscal and monetary management. This scenario underscores the profound influence of interest rate policy on economic stability, stock markets, and societal well-being.